Okay, let's dive right into this. Welcome to today's Explainer, where we're going to tackle arguably the most frustrating paradox in the entire trading world. We are unpacking a truly surgical dissection of a concept from Zor Veyl, the idea of smart broke versus dumb rich. And listen, this isn't about learning some shiny new technical indicator or a secret chart pattern. No, this is an awakening. This is all about transforming you from a struggling, over-analytical researcher into a wealthy, decisive executor.
So, be brutally honest with yourself for a second. Why is your trading intelligence keeping you poor? Because you are intelligent, right? You've probably spent months, heck, maybe even years, mastering the commitment of traders or COT report. You know all about managed money extremes, swap dealer intermediation, open interest cycles. Your analytical frameworks are absolutely brilliant. And yet, you aren't consistently profitable. Or at least you haven't deployed real capital at a scale that actually matches your vast knowledge. So why the disconnect? Well, because the exact same analytical mind that built those beautiful frameworks is the very mind making you freeze the second the trigger actually fires.
Here is our roadmap for today. We're going to cover 1. The intelligence trading trap. 2. Smart broke versus dumb rich. 3. Normalizing failure. 4. The weekly execution playbook. 5. Separating maintenance from trading. And 6. Stop thinking, start earning.
Section 1. The intelligence trading trap.
And this brilliantly illustrates what we call the framework builder's fallacy. See, from childhood, society trains us to believe that showing our work, being super thorough and adding complexity always yields better results. That is what we call the academic lie. I mean, it's fantastic for passing a university exam, but it is catastrophic for trading. The market, it only cares if you place the right bet at the right time. For the COT trader, this turns into the framework builder's fallacy. You start with a simple COT index. Then, you add swap dealer analysis. Then open interest. And sure, each framework genuinely adds value. But here is the fatal flaw. Every new layer adds a brand new reason to hesitate. When the signal finally fires, you pause to check a gross quadrant, the moment passes, and boom, trade missed. Your intelligence literally paralyzed you.
Which leads us directly into the perfectionist's freeze. Because you're smart, you have this deep, almost ego-driven need to be right. A losing trade? It feels like a personal insult to your IQ. So what do? You raise the bar for entry impossibly high. You start demanding 100% perfect alignment from every single indicator. But deep down, you know that perfect setup only happens, maybe once every 18 months? What you're really doing here is using complexity as a safety blanket. You're endlessly optimizing your system as an excuse to avoid live trades. Basically just tinkering under the hood until the market closes, safely avoiding the vulnerability of putting real skin in the game.
Section 2. Smart broke versus dumb rich. Now, what's really interesting about this contrast is who actually poses a danger to their own portfolio. You might think a complete novice is the most dangerous person in the market. They aren't. They're terrified, so they trade tiny sizes. No, the most dangerous person is the smart broke trader. They overanalyze, but under-execute. For them, knowledge without action is just cosplay. Their absolute top priority is a deep need to be right. Compare that with the dumb rich trader, who, by the way, isn't actually dumb at all, but their only priority is getting paid. They rely on a system so simple it practically fits on a sticky note. It literally just says, Friday, download COT. If index is above 80 and falling, short only. Enter on price trigger, 2% risk. That's the whole shebang. They capture 80% of the edge with just 5% of the complexity. While the smart broke trader is still sitting there optimizing indicator weights, the dumb rich trader has already automated their data extraction, executed their trade in 15 minutes, and gone on with their day.
Section 3. Normalizing failure. That smart broke need to be, right? It usually results in refusing to take a loss, praying that price spikes are just market noise, and ultimately revenge trading to try and make it all back. But let's just look at the actual math for a second. The COT contrarian extreme reversal strategy historically has a 55 to 65% win rate. Let's just call it 60%. This proves a really hard truth. Roughly 40% of your trades will be losers. Not might be, will be. The dumb rich trader fundamentally understands that losing is simply the cost of doing business. Those 40% aren't personal failures. They are literally just the insurance premium you pay to maintain your statistical edge in the market.
To enforce this mindset, the dumb rich trader uses a pre-trade acceptance ritual. They literally write down in their journal, I accept that this trade has a meaningful probability of being a loser. It is a statistical outcome within a proven system. They define the exact dollar amount and account percentage they're going to lose before they ever click buy or sell. By accepting that absolute worst-case scenario in advance, they completely remove their ego from the equation. The fear of loss just evaporates.
Section 4. The Weekly Execution Playbook.
In trading, money moves at the speed of decision. The shorter the gap between your signal and your action, the more of that edge you capture. So here is your dumb rich weekly schedule. The absolutely critical window is Friday afternoon. The COT report drops at 3:30 p.m. Eastern and the market closes at 5 o'clock. Now, the smart broke trader uses those 90 minutes to stroke their chin, ponder the macroeconomic implications, and ultimately decide to sleep on it. Well, by Monday morning, the news has processed the data, the crowd has reached a consensus, and the market gaps. The edge? Poof, it's gone. The dumb rich trader, however, auto-downloads that data right at 3:30, checks their pre-written rules, and executes by 3:45 p.m. They are acting while everyone else is still thinking.
So the crucial point is how you handle execution. When a midweek trigger alert fires, your protocol dictates 4 simple steps. 1. The trigger is defined in advance, say on a Sunday when you're in a calm state. For example, if gold hits $2,545 and forms a 15-minute engulfing candle, I short. 2. Your size is pre-calculated by a spreadsheet based on your stop distance. 3. The stop is placed instantly with absolutely no emotional negotiation. And 4. The outcome is already accepted in your trading journal. When that alert goes off on a Tuesday morning, there is literally zero thinking required. You just blindly execute the plan.
Section 5. Separating maintenance from trading.
Now, your COT spreadsheets and your indicators are incredible tools of leverage, but you absolutely have to treat them correctly. Consider this quote: "A factory that sits idle is not an asset, it is a liability." The rich use leverage to scale. The smart try to do everything themselves, limiting their own growth. The smart broke trader treats their frameworks like some kind of intellectual property just to be admired on a shelf. Building a massive, multi-layered COT scoring system, but never executing a trade based on it, that's exactly like a factory owner who endlessly polishes the gears and upgrades the conveyor belts, but never actually turns the machine on to produce goods for sale.
Let's see how this builds into your routine. To make this work, you must draw a hard, absolute boundary between system maintenance and active trading. Monday through Friday, those are production hours. You are only permitted to execute trades, monitor alerts, and place stops. Period. Saturdays and quarterlies, those are your maintenance windows. That's when you can sit down, review your metrics, adjust thresholds, and update the system. But the golden rule here, you never, ever tinker with the factory machinery or change the rules during production hours.
Section 6. Stop thinking, start earning.
This is the mirror moment. You already have the library. You've got the backtests, the frameworks, the beautiful dashboards, and the risk rules. The only piece missing from this entire equation is the version of you that actually clicks the button. So I'm going to leave you with a provocative challenge. This Friday at 3:30 p.m. Eastern, the new COT data is going to hit your desk. When it does, are you going to fall back into the comforting, warm trap of endless analysis? Will you find just one more reason to wait? Or will you finally treat your trading account like a serious business, accept the statistical risk, remove your ego, and execute? The map is drawn, the rest is action. Until next time, stay focused and happy executing.